Time now for a little myth busting, where we dig into common misconceptions about ETFs. Today we're looking at the notion, this is an old hoary chestnut, that the oldest and the biggest ETFs are the best. Todd, you disagree? Make a point about this.
Yeah, I mean, well, the one you just discussed about FXI was the oldest, and there's obviously newer products that are out there. You could look at Japan, for example. iShares has an MSCI Japan product, EWJ.
And that's market cap.
And that's a market cap weighted product. Most of the products that are dedicated to Japan are focused on a cap weighted basis, but we've seen price competition taking place. So JP Morgan launched a suite of single country oriented products. BBJP is a cheaper version of that, similar exposure at half the price. So you can get, and it's now a $3 billion ETF as it continues to see inflows. So that's one example. We've got the quality theme, which is popular these days. That's a fund that comes from iShares on a quality factor. We've seen some newer products that have come out. One that we're going to talk about at the Inside ETF conference is QARP, which is a DWS product that takes quality, focuses on that, but then also looks at undervalued quality stocks, so blue chips at a reasonable price.
When you say quality, I want to make it clear, generally you're talking about companies where their earnings are growing, for example. That's a typical aspect of what you call quality.
These are companies that have consistent earnings growth, that tend to have below average debt leverage, that have strong balance sheets, strong cash flow in that regard as well. But now in this new ETF, you can be able to pay a lower price.
John, just quickly, the idea that the first one out there gets all the assets may be true, but again, it doesn't necessarily mean that's the one to invest in.
Correct. I mean, I think you want to load your ETF into like a quantitative portfolio construction tool. You know, look at the underlying, stocks, aggregate up at the index level to see what the fundamentals are, what the risk characteristics are. You can't just go with, the assets under management or, the liquidity.
Well, let's talk about a potential portfolio, because one of the things we like to do is ask our participants to construct portfolios for us. Now, Todd, you brought along a model ETF portfolio for us. Break it down. You've got an equity component here, and you've got a bond / cash component as well. So let's just take a quick look at the bond component, the stock component of this right now. And tell us what you've got weighted here. Your number one weighting, of course, is the United States here.
Right. So we're favoring U.S. So like you would expect, a home bias. We're favoring large cap U.S. equities. GSLC, which is a Goldman Sachs multi-factor.
You have 40% here in domestic equities in your initial breakdown. Here is your core holding. This is active beta. So this is not an S&P 500, but Goldman Sachs is weighting big cap U.S. stocks in what manner? What's important?
So it's including some of the main factors, so quality and valuation and momentum and low volatility. Those are the four factors that are used. So it's a twist on the S&P 500 index. It's 9 basis points, so it's the same price you pay for SPY. It actually outperforms SPY in 2018. And what we also think is worth doing, the rest of our U.S. equity, is we think with ETFs you can really do a great job of picking themes and sectors and industries. And so we're highlighting a couple of those. A transportation ETF.
Transportation, yeah. So here you essentially own the transportation index, S&P Transportation Index.
You are. So this is an equally weighted product. So you'll have UPS and FedEx within. You'll have some airlines, but you're going to have some small cap companies.
And just 10 seconds. Why are you recommending transports as an overweight?
Yeah. So we think that transportation stocks are going to do well in 2019. Our analysts at CFRA are bullish on those stocks, and that's how we at CFRA are picking ETFs.
Oil and gas, IEO. This is another one. The very, very specific subsector of the energy group overall.
Right. So this is a narrower slice of our suggested U.S. equity exposure. We've seen obviously oil recover in recent weeks, and we think this is a good way of being able to play that through some of the larger cap companies within that industry.
And just to finish this down, John, I want to get your thoughts on international equity. You've got 15% in essentially Pacific Stock Index ETF Vanguards.
Right. So we've chosen this Vanguard product. So this is not a EFA-based strategy. We're suggesting we're more concerned about what's going on in Europe. We think that the Asian markets are likely to perform better.
You're excluding Europe.
So this is excluding Europe in this. You can obviously be tactical with that as well as have emerging market exposure.
I want to show up, John, I want to get your thoughts, though, on equities. I want to show briefly the bond market portfolio, but in terms of the weighting, what are you advising clients globally now?
Yeah, so we think of things a little bit different from what Todd is suggesting. I think you want to kind of temper the risk in your portfolio. So we're advocating much more of a defensive posture. We want higher quality stocks in the portfolio, companies that have like consistently beat their earnings. We think they're going to be rewarded.
Well, when you say more defensive, you mean in terms of the weighting in the equities? So he's got a fairly significant U.S. weighting of 40%. Would you weight it less than that?
I would overweight emerging markets. That's our highest conviction kind of idea, for this year. So going back to what we talked about before with Brendan, you've got lower rates, a weaker dollar, you got a much more patient Fed, and then with emerging markets, there's certain stocks in the EM value space, trading at 9 times earnings, right? So we're using EMMF. It's a WisdomTree emerging market multi-factor ETF. It also combines, value, quality, momentum. So, we just like multi-factor ETFs because the research shows you can get higher up on the efficient frontier.
We haven't gone into this in a lot of detail, and I've discussed multi-factor for years, but is there any long-term evidence that multi-factor really outperforms just simple market cap weighting, that weighting it in a different way than market capitalization? I
mean, there's tons of academic research and literature and books that I've written. We can discuss, I can send it, to listeners and followers afterwards, but yes, it is. I mean, that's why there's products that are available for you.
Todd, I just want to also note that you also have some weighting in bonds as well.
Correct.
Here, investment grade, intermediate corporate bond vanguards, and a high yield fund as well. It's interesting to see, we've seen people recommend against high yield funds this year. I don't know why. They're clipping a coupon at 6%, and if you don't sell, you're still clipping a coupon at 6%.
Right. And
I don't hate high yield.
Right, so there's a risk-on environment that's happening as the Fed is on pause. We think this low-cost product from DWS, HYLB, is a good way of doing it. We at CFRA rate hundreds and thousands of ETFs, and these are some of our best ideas.
And again, you can see all of this. We put these portfolios up on our website, so feel free to go in and look at them in a little more detail. Gentlemen, thanks very much. A pleasure talking with you. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to John, Todd, and Brendan for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, 1 p.m. Eastern Time. Have a good week.